The world is in a global transformational period. My mom always said, reach for the stars. And she said that to women, to people of color. She said that, and I learned that no is never an answer.
Hello, I'm Keisha Shreen, and thank you for joining Climate Money Work. Today, I'm here with our guest, Dail St. Dail is an investor, business advisor, board director, and audit committee member. She focuses primarily on advising private equity and venture capital funds, climate tech and fintech companies, institutional investors, and family offices. Now, Dale is a co-founder of Williams Capital, now the largest women and minority-owned broker-dealer investment bank in the U.S. With her role now with St. Clair Consultants, she currently designs and implements business and investment frameworks, fully integrating ESG and DEI, and importantly, she is RRCA certified in running and as a fitness coach. And I follow Dale and her visuals, and she does great work there as well. Dail, thank you so much for joining us.
Thank you very much for having me. And congratulations on your gambling on green.
Oh, thank you. Thank you so much. Really appreciate that. So I want to get first into where we are, with the economic environment. We're hearing that inflation is cooling and that we may not see longer term higher interest rates, the Fed steadily boosting up interest rates. So with that said, what tools does a board have in today's market to look at new scenarios, perhaps unknown factors or unidentified factors, to get an accurate understanding of a company's financial situation today, as well as what it might be in the near term?
That's a great question in the wake of the recent Fed statement. And, post-pandemic, there was a lot of pent-up demand. So for those sitting in CFO seats, audit committee seats, and other roles tied to finance in particular, looking at a immediate 12-month time horizon alongside the 3, 5, and 10 in some cases, inflation has been factored in for a while. On the investment committee, I sit in on another board. We started addressing asset allocation, which we address, on a 3-year cycle, but more frequently during the pandemic. Depending on how you're diversified, you may look at some hedge type instruments to address inflation, depending on how your portfolio is structured. In terms of corporations, those factors, again, are not surprises. For the most part, it's management coupled with existing supply and demand factors. So the shift should be a realization of what boards, investment committees, finance committees have been discussing, and now, in fact, are executing according to business plans.
So are you really being attentive to the due diligence piece, financial modeling? Would you say that's something that the board is really laser focused on? Is that something that's a management piece that you simply review?
It depends on what committee. I sit on investment committees and finance committees. Boards have multiple committees. This is something generally at a committee level requires oversight, and this is not generally a discussion other than a more statement of fact of actions. At the general board meeting, in the finance and investment committee meetings, is certainly discussed. Sometimes a monthly or quarterly meeting happens more frequently. Certainly if they were quarterly, they did during the pandemic and post. So these are discussions with the staff, and they've been ongoing for even before the pandemic. But certainly, as we know, that the pandemic resulted in major shifts in the economy, and the post-pandemic has been an adjustment period, and here we are today.
So in terms of those things that you're discussing with staff and things that have a lot more prominence today than maybe they did in the past, if we look at environmental social governance issues and sustainability issues, do you feel that boards, specifically the boards that you're working on, are they doing enough to come up to speed on some of these issues that for some people may be relatively new? What's worked well in terms of getting boards up to speed on some of these ESG issues?
Well, that's a great point. For some boards, it is relatively new. For some boards, it is not relatively new, and some boards have taken a position that is not a factor in their decision making. Other boards have taken the position that it is a factor in decision making. And I drill back always, no matter what seat I'm in, no matter what geographic location I'm in. I think, I work with several families in Florida and Texas in particular, and I name those states because it's pretty public, the position on what some of the states have taken on ESG. And I drill back to what is ESG? What is the definition of ESG? Because first and foremost, no matter what seat I'm in, people have different views today, yesterday, and at any time. So it's so critical to be on the same page and understanding what does ESG mean at this particular discussion point, and then drill down to what is in the best interest of the company, what is in the best interest of the portfolio from a risk management perspective. If it's an investment portfolio, particularly at a public pension level as a fiduciary, there are laws that govern the fiduciary portfolios and public pensions in particular. I hope I don't mind, might not integrate public pensions in this conversation, but I do think it's relevant.
Background there, so very appropriate.
I do think that for the vast standpoint of the millions of people that have public pensions, and risk requires that funds to manage assets are managed solely in the best interest of the beneficiaries. And family offices, the heads of the family offices have the discretion of running their capital in the manner that they see fit. So it is understanding what seat you have, and what that definition is, and if it's tied to risk management. Now, the data is clear that ESG, as defined across climate, social, and governance matrix, there's data associated with each of those matrix. I find myself both educating and speaking at the same time on ESG matrix, because in some cases, when ESG comes up, the definition of the individual bringing it up is unclear. There is a common ground when it comes to the UN Sustainable Development Goals, of which there's 17. And each of those 17 goals are specific in terms of matrix, definitions, reporting, evaluating. And I always approach any situation when it comes to ESG is meet people where they are. For, as you said in the beginning, for some people it's new. And for those people or companies that it is new, and if there is enthusiasm to let's do the SDG goals, there's 17, I ask everyone to pause and say, let's speak about each one. Let's understand what the requirements that are written and guidance that is written for each one. And what does that mean to the company or the investment portfolio in terms of time frame to achieve the goal? What is the reporting mechanism? What is the monitoring mechanism? Will it require an additional staff person, or what percentage of time that staff person, a new staff person or existing staff person must dedicate to the monitoring? Before any goal is addressed, those questions must be answered. And often it comes down to, but I don't obviously, my gut is always saying start at one or two, but I always like to arrive at that decision as a group. So once we go through the 17 and once we speak about each one and what that means for whether it's the portfolio or the company in terms of time frame, reporting, monitoring, then it always has come down to one or two. Because large pension funds, and this is public information, the New York State Government Retirement Fund follows nine of the 17, and that's a $250 billion fund. And I don't always say this up front, but sometime toward the end when we get to one or two, and then I share, you have a very large public pension fund that's following 9 of the 17. So I go back to say, what does it mean? And which ones are top frame in terms of addressing whether it's one or two or 4 or 5, and what will that look like over time? And what are our goals and expectations?
Great. And I love that the strategic approach around let's think about the goals, let's think about the outcomes. Clearly, you're extremely well versed in this, working in with a pension fund as well as your work on boards, Verte and others. My question is, if we're looking at identifying risk and clarifying what is financially material, taking that same strategic approach, how would you gain some sort of consensus, speak with and challenge other board members to see this as being framed in a financial materiality structure as opposed to simply ESG for ESG's sake? How do you frame that conversation if you want to influence others? How do you frame it so they can see what's financially material and what is considered a risk without having an ESG thought that might be biased for some folks who maybe see ESG as something that they don't want to include in discussions?
Sure. Well, the marketplace littered with examples, and it's also littered with a lot of data sources, which is good. Good in the sense that there's a lot of choices. The whole world would like more uniform definitions and sources, and maybe at COP28 we will have some of that. But the good news is that because there's a number and some of them are brand names, the data, the information is fairly accessible. When it comes to linking risk management with financial goals, risk management with social goals, risk management with, basically the very operations of the company. Now, I always go back to words that are corporate friendly. And I say that because social goals aren't necessarily, with some companies, a corporate friendly word. But I do go back to, I used to say the most important aspect of many corporations are the individuals that go up and down the elevator every day. But then we had hybrid, and then then we had remote, and so I can't say that anymore. But the reality is, looking at the S in terms of diversity is the way that I address that. And there's data and metrics that go along with diverse staffs, as well as diverse asset managers if it's an investment company. So drilling back to your question, I had the great opportunity to really have the pillars of ESG at the very beginning of my career ingrained in my professional life, which is very much tied to my personal life. So from inception, practically, I grew up with one of the early environmentalists who is also the first female meteorologist in the United States, June Bacon Bursey. I was very close to my mother. She took me everywhere. Every opportunity was to take your daughter to work day. And not that she had to, but she believed in exposure often and early. So I was around Nobel laureates and back when they still have TV sets, but big giant cameras when she did the weather and sitting at UN Assembly. It just an enormous opportunity at a very young age to see thought leaders advancing discussions on the environment and the weather. My first job was at New York City Public Pension Fund, and part of that, my responsibility was managing the Emerging Manager Program as defined as managers under $1 billion. It was not defined by race. It was not defined by gender. It was defined by asset management. The fact was that 94% of the managers under $1 billion were diverse-owned women and minority-owned firms. And co-founding Williams Capital in the 90s, which the success of Williams today is really a tribute to the team, but co-founding a firm in the 90s with a handful of people, and there were several other firms sort of co-founded in the 90s that were women minority-owned in both the investment banking and the asset management space. It was a lonely road, so to speak, to demonstrate to corporations and investment in pools of capital, across the public pension space and all types of pools of capital, that we were, having been trained at some of the large companies, had formed a company that could deliver as good or better business. And today is a different environment, but back then we naturally collaborated. Today there's more collaboration. It's global. But I'm speaking about a time when there was a handful of firms. Some were non-existing, some were still standing. Williams, of course, achieved that. But the reason I bring that up is that the conversation, what does a company deliver in terms of asset management, in terms of bond underwriting, ties directly into the responsibility of the decision maker to look at all the options. So, give you a specific example. This is 2010. I worked with the California Public Utility Commission, which is the regulator for public utilities. And the large utilities in California at the time, was Pacific Gas and Electric, SoCal Ed, and Sempra Energy. And at the time, these utilities were learning about the opportunities and the capabilities of women minority owned firms, given the California Public Utilities Commission was independent. So working with them and sharing with them a host of at least 20 companies, not just Williams, but the universe of companies, so that the CPUC in their conversations and as they educate the utilities about the capabilities of these firms were coming from an independent source. Exelon in Chicago, which is now one of the largest utilities, we've been working with for years, and had done not only managing assets, but also lead underwriter when Exelon came to market in the bond and equity markets. That means that's a position in investment banking that is well sought after. The California utilities had not had a women minority owned firm as lead underwriter before 2010. And so the education of the opportunity was what we were able to achieve with independence. And Williams was not the first firm, disappointing to my colleagues, to have that role. It was actually Luke Capital. The reason I raise this is it's after due diligence and having conversations about what are people concerned with independently, where we're not in the room, but they're with a third party. And I actually asked Exelon to come and speak with Sempra and PG&E, because it, colleague to colleague, I thought would work. So the strategy behind the education was honestly pivotal in a historic moment, at least in the space of the utility investment banking world and the asset management world. And what was the results? The results is that small firms were able to get more diversification of end buyers of securities. And their data points. I mean, I have multiple examples, and I took a little bit more time with that, but I was trying to explain the essence of the opportunity lies in the data. There's not one source. There's multiple examples. I shared one where ultimately the corporation is the beneficiary of more and different shareholders of their bonds versus a Goldman Sachs in the time period that I shared. So it's all about understanding what is the end result, what data supports that, and having conversations is being specific. I mean, I always get to the specifics because I don't know how else to do anything to make sure everyone's on the same page. And
Sure.
honestly, it always comes back as, frankly, it's an indefensible argument because they're facts.
So, just switching gears slightly here, let's get to the advisement piece of things. So, if you are on, say, an advisory board with a climate tech who is really focused on going public or who wants to be acquired by a larger firm, when it comes to the top things that, the advisory board for this climate tech, this physical climate risk data firm, things they should look at if they really want to progress toward the IPO, or if they really want to be acquired by a larger firm, what sort of things would you advise them to do, entrepreneurs and advisory boards?
So companies are staying private longer than even 5 or 10 years ago, for the very reason of proof of concept and capital. And there's a path to stay private, there's a path to stay public, so you lay out both opportunities. The opportunity to stay private, it's essential that the company works institutional quality in an institutional quality manner. Because the opportunity to stay public, it's easier for a large company to see companies operating that way by very different definition that you're public, and your 10 Qs and this information is coming out, you're already producing what large companies and frankly large investors are accustomed to seeing. So when I speak to companies, I try and understand what do they think the benefits of going public are, because it's very different than it even was 10 years ago. And also, then I educate them on these exchanges. It's typically a pre-IPO company. It may be New York Stock Exchange. It may be NASDAQ. It could be the Toronto Stock Exchange. There's multiple exchanges for small and low middle market companies that absolutely all of them should be looked at and addressed, so that the founders and all stakeholders have an understanding of what the options are, and what that will mean ultimately for the company. Depending on the technology, companies only, I try and work with companies that are positioned to scale. It doesn't necessarily mean they're positioned to go public, but it does mean that they're positioned to scale, because scaling any technology is the only path to success and having a sustainable company that could be achieved on a public or a private basis.
So just dig deeper into that. So scaling versus going public, when you say that those should be looked at differently, what questions would you ask, or what sort of things would the founders look at if they simply want to scale versus going public?
I was unclear, and I apologize. I apologize. Let me dial back. First, when working with a company, I evaluate the technology with the lens that, is this scalable nationally? Is this scalable globally? Not every technology, frankly, not every innovation is. It could be a great idea, but it may not be scalable. I don't work with those companies, albeit I certainly refer them to others who I know. If I have anyone in mind, I'm always happy to refer people. If the company's technology is such that it is potentially one that can scale globally, then the question is, what does that company need to achieve that goal? And that's when I map out a path for the company to stay private, and what that would mean in terms of financing, what that means in terms of resources and strategic partners and reporting, and a potential path to go public according to multiple metrics. That those metrics also include the cost of going public, the potential outcome of going public is. For many companies, by virtue of going public, it's not as much about the stock price. It's more about the fact that they now are adhering to multiple regulators and publicly reporting information that gives stakeholders a level of comfort that the transparency is in fact the transparency that they think. And particularly in the climate space, with the overhang of greenwashing, and what that might mean, is somewhat alleviated with a public company, given that this information is public and there's should be very few places to hide. So the opportunity, back to the question of the founders, is they having a fantastic innovative technology. What is the benefits, and what are the risks of going public, from the standpoint of the company's IP, intellectual property, from the standpoint of at what point do they want to fully disclose and share their information or their protocols, and at what point do they want to expand their base beyond their inner circle of investors to the general public or to a broader circle of investors. There's multiple. I actually have 100 questions. So it's
Survey.
Yeah.
The complete survey. Yeah.
This is generally a minimum a month conversation that I'm trying to consolidate in minutes. But I'm trying to not be as detailed given the medium that we're in.
But I think that shows the thoughtfulness that you would anticipate and that you would expect the founders to have as they enter this conversation. This is not something that, just fly by night sort of conversation.
Oh, no. There's an education element.
Sure.
And I always look at the opportunity to educate with anyone, whether it's a founder, whether it's a board of director, a company, or any pool of capital. The opportunity to educate is huge. It may mean that I'm not the right person to work with him as a board member, and if I have a referral, I'm more than happy to do that. But it's so important to define ESG, define the founders' goals, define the financing. There are many founders who didn't anticipate having as much frankly, being successful financially as they find themselves being. And they haven't necessarily thought about trust in estates. I haven't necessarily thought about, should I roll part of my business into a family office structure? I mean, there's a lot of considerations, not just for the founders, but also all stakeholders. And particularly if they want to attract outside capital, what does that look like? And what will that mean? Because, a co-investment from a family office is very different than a co-investment from a venture capital fund or a private equity fund.
Such an exciting time. Those things are on your plate, but also it sounds like it's exciting, but it also warrants a high degree of thoughtfulness going into and
Absolutely.
really understanding what you want your outcome to be.
No, absolutely. And I think also for me, I approach businesses with an institutional quality lens. Not every founder is prepared or wants to be institutional quality, and that is absolutely their decision. And that's when I go back before, is this, whether it's a climate technology or financial technology, is this such that it can scale?
Mhm.
And sometimes the technology is just meant for a much smaller audience or a much smaller region, has no intention of scaling. The founder is not, it has no interest or position to necessarily have the financial resources to be institutional quality, because there is an expense associated with running a company in that manner. So those are all discussion points and facts for founders and their stakeholders to evaluate.
So you raised some great points earlier about your work with Williams and just the environment of being a woman of color, a firm focused on women of color, their emerging managers, the selection there. With the recent Supreme Court decision around affirmative action in colleges and universities, I found, Dale, that it's opened up conversations with corporate leaders around diversity, around inclusion, around ensuring that they have diverse perspectives at the table when they make decisions. I'm wondering, as a board member and as a woman of color board member, what types of concerns are being addressed now? What sorts of questions are being discussed now with using or looking at that Supreme Court decision as an impetus to really drive thinking around bringing in women of color as board members?
Thank you for asking that question. The discussions haven't necessarily changed to the extent of bringing in more women and people of color per se. The discussion continues to be on diversity of thought, which stems from multiple sources, including women and people of color. I always go back to Louis Pasteur and the bovine virus. You may have heard this. The bovine virus, which is derived from cows, it was discovered after men and scientists of the time, leaders of the time, leading executives from all industries, including science, were trying to determine the smallpox vaccine, because smallpox was ravaging Europe. The smallpox vaccine is bovine based. The reason it's bovine based is because after months and months of trying to figure out the smallpox vaccine, what one would look like, a farmer said that the milkmaids were not getting smallpox. And why was the farmer in the room? I don't know. We can speculate all day. I've actually tried to figure out how, after months and months, that farmer is in the room. I can't say that, so I won't speculate. But I will say that after months of these scientists and thought leaders from all around the world, not just Europe, farmer in the room made a statement. And that's why the smallpox vaccine is bovine based. I share with you that diversity of thought is rooted in race, rooted in geographic location, rooted in, frankly, labor, rooted in gender, and rooted in gender from all types of identifications of gender, which we are now better positioned as a world to speak about today. So diversity is demonstrated by many different avenues. no matter what the industry is, it's evident that contributing to thought process and important decisions that corporations are positioned to make, whether it's a Fortune 50 corporation or a Fortune 1000 corporation, the fundamentals around risk management, around governance, around investments and finance, around human resources, strategic planning. These are all elements of decision making that benefit from diversity. And there's data that around all of these factors and more. And that's often why I go back to the 17 UN PRI principles, because it's easier for me to connect data with, 17, health, education, inclusive environment. I'm saying this from memory, sustainable economy, climate change. 17, it covers what every company will end up thinking about. It's the course of the business they're running, no matter what the industry is.
I want to wrap up talking about something I was really excited about you sharing with us. And I know we've spoken about this in the past. Your mom, who was just inspirational to many folks from the climate area to meteorology to those of us who are in broadcasting. I mean, it just covers a lot, and her legacy really covers a lot. And I'm wondering if there was a piece of advice that she shared with you or shared broadly with mentees that you want to socialize because you think it's really that important and that universal. So a piece of advice and nugget of wisdom that your mom, first female meteorologist, broadcast TV, that she shared that you think in this particular day, at this particular time where we are as society, would really resonate. What would that piece of advice be?
I think the world is in a global transformational period. My mom always said, reach for the stars. And she said that to women, to people of color. She said that, and I learned that no is never an answer. And that's why, I share with you about education, because I always find I learned from her. Education is on the same page. I learned for her preparation. And that I look at a woman who in 1979 she was a broadcast journalism. She was also a government scientist at NOAA and the Atomic Energy Commission. So she wasn't, a multimillionaire. She chose a road of service for the most part. And in 1979, started the June Bacon Bursey Scholarship for Women to study meteorology. As a single mom of two girls, I couldn't figure out how she did that. She was asked to star in a show, John Philip Sousa, which won $100,000, and that was the foundation of a scholarship. Now, my mom was deeply religious as well. I don't know how she got invited on the show. It was about preparation. And so she spent, in addition to working and being a mom, there were 70, 80 hours a week studying John Philip Sousa, because that was a topic she chose, knowing that was her ticket to found a scholarship that she had been dreaming about for 10 years. So I will say to reach for the stars and with conviction and faith, because I see the vision that my mom had and the path that she was prepared to realize her dream. Most people don't know that she actually became the first female meteorologist, frankly, in the world in the 70s, not because she was asked to be. She was credentialed and had asked all over the country and all the no's, and she took a position as a weather reporter, which I couldn't understand as a young girl, because she was at the Atomic Energy Commission. She had left the National Weather Service to become a weather reporter. But that was my first lesson, and seeing how she was strategic in her career as a weather reporter and being prepared to step into the role of chief meteorologist, albeit that was not her position. The chief meteorologist robbed a bank at WGR in Buffalo and in the early afternoon, and there was no one to step in to do the 5 p.m. news. And my mother knocked on the door and said she was ready, and it was an interim position up until she came on the air and the public spoke. So I share these things to say it's not about the how, it's always about the vision and being prepared and reaching for the stars, when it's seemingly completely impossible odds. I'm very fortunate to have grown up with my mom and watched her do, not just with her career, but also lay the path for others. She started funding the meteorology lab at Mississippi State University, a historically Black university, because after she started the scholarship and wonderful women applied, there were no people of color. So part of the credentials of being a meteorologist is having lab time. So of course she's going to look at the historically Black colleges because they're all mostly going to be people of color. So my mother was always strategic cause solution that lab exists today. And when she passed 2 years ago, I had a chance to meet some of the graduates at Jackson State University, JSU, from what she started. So I try and honor her legacy every day.
Well, thank you so much for sharing this with us. And Dail, thank you for sharing so much more the importance of risk management, the importance of really creating a strategy when working with a company who's really keen to move in a direction, finding out the reason why, finding out the expected outcome or the desired outcome. And even when advising companies such as climate tech companies, really getting a sense of why they want to go public, and if it's in their best interest based on the data, based on what they share, if they should focus on scaling or when they should focus on going public. And of course, thank you so much for sharing so much about your mother's life, her journey, her legacy as a scientist, as a woman in STEM, as a philanthropist, and as a teacher who shared with you and many others to always be prepared and to always have the vision, and then from there reach for the stars. Dail St, thank you so much.
Thank you for having me. I really enjoyed our conversation, and I look forward to sharing your book with many others. I just finished it yesterday.
Oh, wonderful. Thanks for joining us on today's episode of Climate Money Work. Please follow the show wherever you're listening right now. If you have any questions, feedback, or pitches, please get in touch with the team at cmw@shrugcontent.com. Again, that's cmw@shrug, SHRUG, content.com. Now you can learn more about the show at keisashreen.com/podcast. You can find me on LinkedIn, Twitter, and Instagram. I'm Keisa Shreen, and thank you for listening. Be well.